In the previous video, we talked about why self-sabotage happens psychologically. In this video, I want to show you what it actually looks like in trading behavior. Because most traders don't blow accounts because they lack information. They blow accounts because emotions affect execution. So let's talk about moving stop losses, because almost every trader has done this. You enter the trade, you risk 1%. You place your stop loss at the point where your analysis becomes invalid. In other words, if price reaches this level, the trade idea no longer makes sense. That's why my stop loss is there. But then the trade starts going against you, and suddenly the emotions begin. You wait for the setup. You're emotionally invested in it. You believe this could be a big move, and now the market's doing something different to what you expected. So what happens? You start justifying. Maybe it's just sweeping liquidity. Maybe the real level is lower. Maybe it just needs more room. And suddenly you begin seeing things you didn't see before. Or maybe you did see them before, but when you were thinking logically, they didn't carry the same emotional weight. Now they do, because now you're emotionally attached to the outcome. And it's similar to toxic relationships. The market is like a person you can never fully control or fully predict. All you can do is show up with discipline, follow your process, and respect the outcome. But emotionally, traders can't detach from it, and the mind starts creating justifications. Trading works the same way. The moment the trade starts threatening your emotions, logic starts weakening. This is why I believe stop losses need to be hard stops. Because yes, sometimes the market will spike you out and reverse, and that feels frustrating. And there are also times when the stop loss saves you from a much bigger loss. Once you start moving stop losses, you begin emotionally committing to the outcome. Now, you need the trade to work. And the further you move the stop, the stronger the emotional attachment becomes. It's a slippery slope. I've seen traders destroy entire accounts this way. So now, even if I think the trade may bounce, I let the hard stop get hit, because I'd rather lose 1% and reassess than lose 3%, 4%, or an entire trading account trying to avoid being wrong. Let's talk about revenge trading. Nobody likes losing. Everybody wants to get it back. Losses stay with people emotionally. Revenge trading becomes personal. You feel bruised. You feel defeated. You feel like the market embarrassed you, and now you want to win back control emotionally. The dangerous thing is, when traders revenge trade, they stop thinking clearly. The only thing they care about is, I need to get the money back, and that emotional urgency changes decision making completely. There's a saying, revenge is a dish best served cold, and another saying is, holding on to hate is like drinking poison and expecting the other person to suffer. Revenge trading works the same way. You think you're attacking the market, but really you're only digging yourself deeper into the hole. Most traders do not lose because of strategy. They lose because emotions affect execution. Your emotions will affect your timing, discipline, patience, perception, and risk management. Everything changes emotionally after a loss. And one of the hardest things about trading is this: you can work hard, analyze properly, be disciplined, and still lose money. That's difficult emotionally, because in most areas of life, effort usually gets rewarded. Trading doesn't work that way. Sometimes you can do everything right and still lose. And then there's the pressure from other people. People doubting you. People questioning trading. People thinking you'll never make it. So now, when you're down for the day, revenge trading becomes emotional validation. I need to prove I can do this. I need to prove them wrong. When your only goal becomes, I just need to win this back, that's when hope takes over. Logic disappears. Discipline disappears. Now you're gambling emotionally. This is why daily limits matter. Maximum trades. Maximum daily loss. Walk away rules. Because these rules protect you from yourself emotionally. Sometimes the smartest thing isn't continuing. Sometimes the smartest thing is stopping, recovering emotionally, and coming back tomorrow clear-headed. The market will still be there tomorrow. Another opportunity will come. Protecting your psychology is more important than trying to win back one bad day. Overtrading is addiction to action, constant involvement, feeling like you always need to be in the market because logically it seems to make sense. The more I trade, the more money I make. In most jobs, more effort usually gets rewarded. But trading is different. In trading, sometimes the more you do, the worse the results become. Overtrading is like carrying a bucket full of water and then poking holes in it on the way home. You already had enough, you already made money, but emotionally you still needed more action. And slowly the profits leak away. This is why trade limits help. If you decide, I only take 3 trades per day, then after 3 trades you stop. Now overtrading becomes impossible because the rule protects you from emotional excess. Fear of missing out is one of the biggest emotional traps in trading. We saw it in crypto, we've seen it in housing markets. People pile in emotionally near the top because they think, I don't want to miss this opportunity. And emotionally, FOMO intensifies over time. It starts as, I think this could move, then becomes, this is definitely moving, and then becomes, it's moving without me. And now the trader jumps in emotionally. Usually late, usually at a worse price. That's not business, that's emotional chasing. The market is always moving. There will always be opportunities. Forex alone is one of the most liquid markets in the world. There is opportunity constantly. So instead of chasing emotionally, collect data, observe setups, mark levels, study outcomes. Because the more data you collect, the more you realize opportunities are everywhere. They repeat constantly. And when you realize that, scarcity starts disappearing emotionally. Entering trades too early usually comes from emotional impatience. The waiting itself becomes uncomfortable, especially with break and retest setups. Because you need the breakout, the pullback, the confirmation, which means you have to wait. And emotionally, many traders struggle with waiting. Sometimes traders enter early simply because if I enter now, the waiting is over. The emotional tension disappears. Entering too early is premature judgment. It's the trader believing they already know what happens next before the market has confirmed it. If your strategy says wait for the breakout and retest, then entering early means you ignored your own rules emotionally. And this is important. If you truly trusted your strategy, you'd wait for the setup to complete. Avoidant behaviour is when traders avoid looking at the real problem because discomfort is uncomfortable emotionally. Nobody enjoys confronting their weaknesses. Some people avoid checking bank accounts. Some people avoid difficult conversations. Some traders avoid reviewing their losses honestly. Why? Because avoidance temporarily protects them emotionally, but growth happens when you honestly confront your behaviour. It's like driving a car that's making a horrible noise, but refusing to investigate it properly because you're afraid of what you might find. Eventually, avoiding the problem makes the damage worse. You cannot fix behaviour you refuse to look at. The first step is awareness. You have to admit, I'm the one that's getting in my own way. Because once you fully and truly become aware of your behaviour, you finally have the ability to change it. Assuming your strategy actually has an edge, then the real problem usually isn't the strategy. It's execution, it's behaviour, it's emotion. You don't blame the bullet for missing the target. You look at the person firing the gun. The issue isn't strategy itself. The issue is how the trader executes it emotionally. Who moved the stop loss? You. Who revenge traded? You. Who ignored the rules? You. And who entered early? You. And that's actually empowering, because if you are the problem, then you can become the solution. Discipline starts with awareness. You have to become conscious of your own behaviors, not from judgment, but from honesty. Because once you truly see the behavior clearly, self-sabotage becomes much harder to ignore. And look, I'm probably not telling you anything that deep down you don't already know. Most traders already know when they're moving stops, revenge trading, overtrading, forcing setups, or breaking their own rules. The real challenge is becoming aware of it while it's happening. Because once you become aware of the behaviors that are hurting your trading, you can start changing them. And that's what this channel is really about. Trading psychology, discipline, self-awareness, learning how to stop getting in your own way. So if you want to become more disciplined, more self-aware, and develop the mindset needed to survive in the markets long term, subscribe, and I'll see you in the next one.